Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, so whilst US did drift a little bit on Friday, but on the week did finish higher. We've obviously got bearish sentiment in general that was kicked off by the banking crisis in early March, but we have got positive seasonality in April. Those two are kind of battling it out right now, but we also got the big banks beating expectations with JP Morgan up around 8%. So those are things kind of helping the market manage to end in the green. We did get some more hawkish Fed comments, which did knock the wind out of gold sales a little bit. And we got a pull back down towards 2000 again. So obviously that big psychological level in gold. But, you know, we're looking at a 2 sigma move down on Friday, which was pretty big. And then oil managing to hold on to recent gains since OPEC cut. Hasn't really filled that gap yet. Not sure if it will, but it's trading quite well. And then Nat Gas finally trying to stage a bounce, managed to be up 4%, looking reasonably firm overnight, but you never know with natural gas, right? This thing's on an 80 vol, can kind of do anything. Okay, looking at vols have been crushed across the board as markets kind of get pinned into that April OPEX. That is this Friday, and we've got the VIX hitting 1-year lows around 17. Commodity vols have also been softer in general, but they do trade at much higher vol levels than equity indices. And that is just due to commodities winging around a bit more in general, having more wild moves, obviously like the sort of stuff we've seen in silver and gold and in oil recently. So, you know, I wouldn't expect commodity vols to really get down as low as equity vols, but they have all been heading in the same sort of direction. Looking at carry, we've got positive equity carry across most indices except for Japan. Obviously, that got Warren Buffett endorsing it again and got a bit excited, rallied 3.5% last week. But outside of that, positive carry across the board. And then commodities, carry was pretty mixed. We saw gold and oil in negative, having decent swings, whilst GDX and copper remained the best in terms of positive carry. Skew did reset lower on the week, along with implied vols, as the banking crisis does seem to be on hold right now. And bearish investors don't really need to reach for put protection if they've already de-risked and sold futures against their longs. If earnings do continue to beat low expectations, and it's debatable, you know, whether earnings expectations are too low or not. Some people would argue that earnings expectations need to be a hell of a lot lower. But in general, if we get the likes of what we saw out of JP Morgan and we've got a beat on expectations, then we may see skew back down towards the lows that we saw late last year, early this year, as upside protection might catch a bid, because with a lot of bearish investors out there, they're probably not as long as they need to be if this market wants to break 4,200 on the S&P. Okay, look at the charts. So much dollar hate. So message here is that over recent months, you know, one clear consensus that seems to be forming is that the dollar is going to go lower. Whether it's the China reopen, the Fed pivoting faster than other central banks, most investors seem to think that is one of the key trades of the year. Euro positioning as a result has got quite stretched, and the ECB does continue to make hawkish noises as that European inflation cycle seems to lag the US cycle by about 6 months. And you know, there's a sense that the US banking crisis isn't going to spill over to Europe due to better regulation or whatever. That's what they're kind of saying in Europe. Okay. Now, history does show that the ECB doesn't have a great track record of knowing when to quit hiking. So think of summer 2008, think of 2011. They managed to hike into the face of a bit of a crisis in both those occurrences. And it may well be they are about to repeat that mistake. Now, if the speed of how Credit Suisse collapsed in March is anything to go by, I don't have the same confidence that Madame Lagarde has that Europe is going to be immune to a potential credit crisis triggered by the US. So something to be careful of. So euro may well be a good opportunity in the more medium term to be selling into this strength. Another interesting observation regarding the dollar is that if you look at the dollar's correlation to risk assets, we all know that the dollar tends to be a bit of a safe haven. It tends to be negatively correlated to the S&P, right? If we look at sort of meaningful size moves. So it's got the unique property right now that you can basically have a risk off trade in your book that yields positively, right? Because you've got positive carry in the dollar. Because right now you can earn in the short end of the dollar curve, you can earn 4% plus. So maybe that partly explains why volatility markets are getting crushed. Because right now, investors can say, well, we can just de-risk our books, we can park ourselves in cash, earn a positive yield, and know that that dollar cash is probably going to do quite well in a risk-off market. So we don't need to then sit there invested and buying expensive hedges and paying for that option premium that we normally would when you've got the dollar as that risk-off hedge with positive yield. So we think that that might be playing a part in this kind of cross-asset volatility sell-off that we're seeing. Okay, but there's also seasonal factors as well. Okay, looking at our theme for today, we've been keeping an eye on copper prices. We obviously were carving out this kind of triangle structure on the chart in copper, and we have popped our head above it. We're now retesting that as support. Now copper has obviously been, not performing quite as well as the likes of gold and silver, which is why we did these FCX call ladders that we pointed out a few weeks back. They've done pretty well so far as copper's held above that $4 level. FCX has had a nice run back up to $43. Now, the copper warehouse stocks, if we look at the exchange monitored warehouse stocks, LME, COMEX, etc., these are pretty low. They're actually at a 15-year seasonal low for this time of the year. Obviously, the green transformation story is going nowhere. And we think, a China reopen as it starts to gather momentum may well bring demand back for copper. We also see speculative positioning relative to the other metals in copper is very light. So you have got some factors there supportive of the metal. If we look at the volatility side of things, this is something we flagged in our weekly report. And this is, if you look at this strategy compass, we've got silver calls relative to copper calls, or volatility in general, right? So we've got copper volatility near the lows, if not at the lows, on the 18-month kind of history. We've got silver at more median levels, right? We've also had skew flip towards copper in the near term. So whilst gold and silver calls have been trading at a premium for a while, and that happened before the big explosion higher in those two metals, we have recently seen copper calls catch a bid and take the premium back from puts. So it may well be a leading indicator, like it was for the other metals, that copper is due to have a go, because some people are piling in and buying calls here, basically. So that's something to be aware of. We think there's relative value opportunity in doing what we call a call switch. People who have followed me for a while know my MO. I like these sort of relative value trades when I think there's relative value in the spot, but also in the volatility of between two assets. I like to do switches, call switches, put switches to play that scenario. So the idea is I can structure a trade where I'm long calls on copper, short calls on silver, not pay a lot of premium. And if I get the move I'm anticipating in copper, then the trade's going to kick in and make me some money. So that's the idea. I'll be looking at June 23, SLV, sell the calls on SLV, buy the calls on our copper proxy, which is FCX. That's the one we like to use because it has a more liquid options market. You do need, when you do pair trades like this, you want to look at the correlation. You want to check these things actually do move in line with each other to some extent. Typically, FCX and SLV, whilst they're not directly that strongly correlated, it does tend to live around 60%, that correlation. It has come down a little bit recently with silver moving so violently up and copper not really doing a ton. But we think 60% correlation is reasonable. We also look at the chart here, FCX relative to SLV. This thing sold off 20% in short order. So we'd be looking for a bounce back up to here. And in general, you can see it's making higher lows if we go back over the last year or so. So for me, that's an encouraging sign as well. And so, I think there's room for this definitely to move the way we want it to, right? We've also got an earnings kicker. FCX, Freeport-McMoRan, has got earnings due this Friday before the open. So that might also give the stock a bit of a kick to the upside. If you want to discuss this trade in more detail and you're one of our subscribers, make sure you hit me up on Discord with any questions. But that is the idea for today. All right, guys, thanks a lot for listening. I'll catch you all tomorrow.